Well, hi there. Welcome to All Things Retirement. Well, in this video, we're going to talk about how tax planning changes when you retire. And it definitely goes through some pretty significant changes. So we're going to talk about those changes and how you can proactively get ready to fully harness the flexibility that you'll have when you transition into retirement. But in the grand scheme of things, what you find is for most people, they've got a T4, maybe they have some T-slips from investments they have. Maybe if they have a partner, they have to make some decisions around how to handle credits or deductions. But for the most part, unless you have a business or rental properties, it's relatively straightforward. But when you move into retirement, all of a sudden there is complexity. That complexity comes with the tremendous amount of flexibility that you have when you transition into retirement. So that flexibility will relate to, when do I take government benefits? Do I defer them? Do I take them as soon as I can? What about triggering income from your registered account? So when do I take my RSP and RIF it? When do I take money from my LIF account? What about my non-registered holdings? Do I take money out of those or my tax-free savings account? Those are all important decisions, and they do have tax implications. And of course, if you have a partner, there'll be some income splitting opportunities or income splitting decisions. And then finally, all of these decisions will have a ripple effect on your overall estate over the years and can have an impact on income sustainability. As well, in this video, we'll talk about a really important planning tool that you can utilize to replicate future decisions and find out what the ripple effect is in terms of your tax planning. How do you actually put more money in your pocket, not just next year, but for many years to come? Now, if you're new to our channel, make sure you hit subscribe so you don't miss future content that we're posting on a regular basis on various aspects of retirement and wealth planning. And if you're getting close to thinking about retiring, you may want to take advantage of our complimentary retirement income planning forecast. There's a link in the show notes where you can get back to our website to find out more information about that complimentary service. Okay, let's talk about some of the key factors. Okay, so as we get into this discussion around tax planning when you retire, there's maybe three factors that are always humming in the background. Number one, with more income and investment buckets come more choices and trade-offs. And we'll talk about software applications that we use for our own clients to help them to make those really tax-effective trade-off decisions. Number two, deaccumulation looks an awful lot different than your accumulation years. So when you're saving for retirement, it's about tax deferral and building assets. You're not producing income. But when you retire, as you deaccumulate, there's going to be tax consequences. And so that's always at play when you look at your retirement strategies. And again, looking at the trade-offs and doing the calculations becomes critical then. And then lastly, start planning at least 5 years before retirement. Now, if you don't have that much time, that's fine. Planning is always valuable. But ideally, when you think about retirement, the more of a runway you have for your tax planning, the more you can get ready to fully harness the opportunities that will be available to you. And in addition to those factors I just talked about, you'll want to divide your tax planning in retirement into three different phases. We've got the pre-age 65 phase, we've got the age 65 to age 71 phase, and then we have the age 72 and older phase. So we'll talk about some of the aspects of tax planning in each of those phases. Okay, so let's talk about the pre-age 65 phase. If you're fortunate enough that you can retire before age 65, awesome. And this phase can create some great tax planning opportunities. So this is a phase where you're beginning to decide which assets do I draw down first to supplement my retirement income. Do I go into my RSP RIF? Do I go into my non-registered account? Do I even use my TFSAs? So this is where you're anticipating future trends from a tax planning standpoint. I know for our practice, again, we'll show you an example of a software application we use to help our clients anticipate the future. And by knowing the future, that might lead to decisions that maybe are counterintuitive to some clients initially. In other words, drawing more money out of their RSP RIF accounts than what they need, because exposing that asset to a lower tax rate now might save them taxes down the road. So the idea is to level out your income over time. So it's striking a balance between the tax bill today and the lifetime tax bill of your cash flow over time. So sometimes people will end up taking more money out of their RSP RIF accounts than they need. They'll pay what might be a lower rate of tax in the early years and then push the excess into their TFSA account or non-registered account for future use. Now, what this can do as well is that for some people, depending on their income, it may mean that they will not be subject to clawback. So sometimes what you see people doing is deferring, not taking any more taxable income than necessary because they don't want to pay the tax bill today, but it builds up a deferred tax liability that in the end stings them because they might be subject to old age security clawback levels. Now, the other thing that happens during this phase is that you might be able to tap into the pension income tax credit. So if you have $2,000 of qualifying pension income, there's a 15% credit against that dollar amount. It saves a bit of tax on that income. Then you could qualify in that pre-65 phase. But it's a limited amount of income that will qualify. Essentially, it's superannuation or defined benefit pension income. So if you're fortunate to have a defined benefit plan that's paying income before 65, you can qualify for the pension income credit. And if you're splitting any of your pension income with your partner, so you can split upwards of 50% of defined benefit pension income to your partner, that income will qualify for the pension income tax credit as well. So that's $2,000 times 2, so $4,000 of income subject to the pension income tax credit, so you get tax relief on that level of income. Okay, now you're in the age 65 to 71 phase. So what are some of the tax planning opportunities you need to be available? So first of all, at age 65, you get access to the federal age credit. So that amount is $8,790 in 2024. If you have a partner, that's $8,790 times 2. So when you add in the age amount plus pension income tax credits, if you're in a couple situation, that's basically about $20,000 of tax credits. And so that could end up being savings for a couple of close to $3,000. So it's not insignificant. The other thing that happens is the pension income splitting rules are now more expanded. So keep in mind that pre-65 age group, it really was just defined benefit or superannuation pensions that will qualify for pension splitting. But now that you're 65, you can move money from an RSP to a RIF account. That RIF income will qualify for pension income splitting. You also want to make sure you do that even if you don't need the income, start kicking out at least $2,000 per year. That RIF income will qualify for the pension income tax credit, so you can at least tap into that. As well, you can consider applying for the Canada Pension Plan sharing program. So often you see in couple situations, particularly one might have more CPP accrued benefit than the partner. What you can do is you can apply for pension sharing. Just go to the Service Canada section. There's an application form. And basically what happens is they just add up the two benefits, divide by 2, and equalize the pension income. So it ends up being a bit of income splitting on your Canada Pension Plan benefits. And then at age 65, you're going to make some decisions about old age security. Do you take it at age 65? Do you defer taking it? Sometimes there's just some practical reasons for deferring. Like if you're still working, you're making contract work, if you end up giving back a good chunk of your OAS benefits because of clawback, you probably just want to defer it until your income drops. For some people, they'll defer it because they view old age security as another defined benefit pension plan that's fully cost of living indexed. So if you defer it from age 65 to 70, it's going to increase the old age security benefit by 36%. Same idea with Canada Pension Plans. So sometimes you see people deferring CPP benefits, and what they'll do is at age 70 start taking it. That enhances a benefit by 42% from what the level would have been at age 65. And again, these CPP OAS decisions should be made also in the context of tax planning. So sometimes what you see people doing is deferring those government benefits to create more of an income window to draw upon their RSP RIF accounts, expose those to tax, and then eventually using the government benefits to supplement their income. Well, now we're at the age 72 and beyond stage of retirement tax planning. By the time you get to this stage, there's actually not a lot of planning you can do. So all the planning proactively that you've done through your retirement journey likely took place in your pre-65 phase and your 65 to age 71 phase. So this now is a phase which I would call less flexibility phase. So without proper planning that happened in those prior years, you could be in a situation where a whole bunch of tax-deferred income now is being forced to be paid to you. And that could reduce old age security benefits because you might be subject to clawback. And there could also be a pretty significant deferred tax liability on your estate. So another part of tax planning is not just on the income you'll be receiving over the years, but trying to maximize the overall estate value that might go to your family, if that's one of your priorities. And one of the strategies is to try to wean out that tax liability incrementally over the years, as opposed to having a very large tax hit when you die later on. So that's a very important component to the planning. Now, effective planning really starts early in your retirement journey. That's really the lesson, I think, embedded in our discussion today. So now let's just take a look at the software application that we use to try to give people guidance on how to generate income in a tax-effective way as they're trying to make those trade-off decisions about deferring old age security, CPP. Do we draw more money out of our RSP accounts or RIF accounts in the early years? So let's take a look at that software. Okay, this is our software, and you can see that we've got Sam and Sally YouTube. And you can see in these schedules, this is for Sally, and we've got Sally taking Canada Pension Plan at age 60 and her old age security benefits at age 65. And that's very standard. Most people will take their Canada Pension Plan benefits early. Now, if we go across to this, it says CFM order, it's cash flow management order, and you can see under withdrawals, the program allows us to go into a drawdown strategy of either non-registered registered TFSAs or maybe registered non-registered TFSAs. So we can model different drawdown strategies to see what is more efficacious in the planning. So in this planning, we've got them living basically until their 90th year. And what we would do is we would go in and model different scenarios. So one scenario is the traditional scenario. They take CPP benefits when they're available to them at age 60, and they take their old age security benefits at age 65. And we use a traditional drawdown strategy of non-registered registered TFSAs. Then what we'll do is we'll build another model that has them deferring their pension plans to age 70 as an example. So we're going to create a bit of a window of opportunity in the early years of the retirement that we can draw down more money from the registered accounts and expose it to tax. And then we would go in and model this scenario for them. We'd do a non-registered registered, we'd do a registered non-registered. And over the years, what happens is this program will give us overall estate before tax and after tax values. So when we create the two scenarios, we can then compare each of the scenarios in terms of what's going to put the most amount of money in their genes over the years based on the drawdown strategies. This is really one of the only ways you can really get clarity on what makes most sense for your particular circumstances. You know, how do you make those judgment calls and trade-off decisions about drawing down different buckets of assets and triggering different forms of income? This kind of application is ideal for getting clarity on those kinds of options. So again, as I mentioned at the beginning of the video, if you're interested in getting a complimentary retirement forecast, we'd be pleased to connect with you on that. And when we do connect, I'll talk about our applications and how we can use these tools to make sure you're planning effectively. As well, if you haven't subscribed to our channel, make sure you do that so you don't miss future content on retirement and other aspects of wealth planning. Anyway, wishing you all the best in your retirement planning journey. You take care. Bye-bye.